Good day, everyone. Welcome to our webinar, our first webinar for 2024. It's been a long time since I spoke with you before, but as usual, we'll start in America. Plenty has been going on, plenty has happened. You see on your screen the S&P 500 over the past 5 years, and there you can see on the left-hand side, you can see the COVID-19 downward spike. And then the previous record high, which occurred on the 3rd of January 2022, that was followed by an exceptional 25% correction, what we now know to be a correction. And then the bull trend reasserted itself and broke to a new record high since I last spoke to you. As you can see here, it bumped along underneath this level of 4796 before breaking above it. So that is quite normal. You can see how the importance of previous cycle highs shown quite clearly here. So it bumped it 2 or 3, 4 times and then finally broke through very powerfully, and it's moved up to a strong high new level. Now you must understand that a resistance level like this, 4796, once it has been breached convincingly like that, then becomes a support level. So what we can expect from a technical aspect is that the market will probably retrace back, will probably correct back to this level of 4796, and that will become now a support level. So what was resistance will then become support. That's an important principle to get a hold of. All right, looking at the American situation, gross domestic product in the fourth quarter was up 3.3%. And that, of course, comes on top of the whopping 4.9% growth in the third quarter. This is extremely strong growth for a $23 trillion economy. And especially when you consider that interest rates have been put up by 5% in the last year or so. Economists were only predicting a 2% growth in the fourth quarter, but it came through at 3.3%. So it really shot the lights out. At the same time, the US economy created 353,000 new jobs in January this year. That's a massive number of jobs, about double what was predicted by the economists. So this shows that the economy is far from heading into recession. It's not even considering any kind of soft landing. This economy is booming. That's what we see here. Note also that this is the 24th consecutive month that the unemployment rate has been below 4%, because it came in at 3.7% at the end of January. That also indicates that the economy is not in recession or anywhere near recession. So the possibility of a recession and a rate cut in March have had to be suspended. They are now basically forgotten. Investors are now debating a rate cut from the Monetary Policy Committee at its meeting on the 1st of May. And of course, the S&P 500 has made a series of new all-time record highs, as you can see from the chart in front of you. The sharp upward move is being driven mainly by tech companies, shares like Nvidia, Meta, Amazon, and even Microsoft. Microsoft was up 1.8% on Friday. The White House economist Jason Bernstein says he spoke of what he called a virtuous cycle. An increasing number of people are working with wages that are beating inflation. And that, of course, is pushing up consumer demand, which accounts for about 70% of gross domestic product. And even the US voters are beginning to give Biden some credit for what is a really good economy. Since January 2021, the economy has created 15 million new jobs, which is something of a record. This has got an impact on the November presidential elections, in my opinion. Consumer confidence jumped 13% in January 2024. So the Republican talk of a depressed economy is beginning to look really foolish. Both Nikki Haley and Donald Trump have been predicting a depressed economy. And that is not happening. So we believe that Joe Biden will beat Trump by an even wider margin in this election than he did in 2020. There's only one possible negative in the US economy at the moment, and that is the yield inversion on US Treasury bills. Normally, the yield on the 10-year T-bill is higher than the yield on the 2-year T-bill. But sometimes that relationship becomes inverted and the 2-year T-bill yield is higher than the 10-year, which is where we are now. And in fact, we've been in that position for 18 months. Normally, when you get a yield inversion like this, it is a good indicator that there is a recession coming. And in fact, it has been an accurate predictor of the last 8 recessions in America. But I think this time it's going to be an exception. The inversion reached a maximum on the 8th of March 2023 at 1.07%. It has since then moderated to just 0.33%, and we believe that it will move back into positive territory quite soon. So the inversion, just to refresh your mind, is the 10-year yield minus the 2-year yield. So it's at the moment at minus 0.33%. In our view, the bull market, the bull trend on the S&P 500 remains a function of the quantitative easing that was put in place in response, first of all, to the 2008 subprime crisis, and then subsequently to the COVID pandemic. Massive amounts of money were literally printed and injected into the US economy and other economies around the world during this time. And what we are seeing now is the continuing reaction to that increase in the money supply. Trillions of dollars were printed and injected into the world economy. The huge cash injection is being felt in unexpectedly high economic activity levels and corporate profits. At the same time, productivity is being boosted by new technologies. The gains in productivity are ongoing, and they are ubiquitous. In other words, they're right across the board. We can expect the S&P 500 and other markets to continue rising until those gains in productivity are fully discounted. Our calculations, rough and crude as they may be, indicate that the S&P 500 will rise to at least 6,458. In other words, by a further 30% from current levels. What is interesting about this market is that at the same time that the S&P 500 is making new record highs, other indexes, and particularly the index of Shanghai, which is a good measure of the Chinese economy, has been falling. So if I just go to that chart, you'll see what I mean. Okay, I'm going to put a bit more data on the screen here. Right, here you can see that it made a high, the Shanghai Stock Exchange made a high in 2021, and since then it has been on a steady downward trend, which is continuing even to today. Now, this is probably because of what is going on in the property market in China. Property accounts for about a quarter of the Chinese GDP. So Chinese GDP last year, according to the authorities, was 5.2%, and it's expected to be about 5% this year. But we find those figures quite difficult to believe, especially given the fall in the Shanghai Stock Exchange Index. The major problem, of course, has been, as I said, in real estate, and especially now that the largest real estate developer in China, Evergrande, is to be liquidated. Evergrande is being liquidated with about 270 billion euros worth of debt. The Chinese government is obviously concerned about what is happening on the stock market, and they have announced a 290 billion rand injection into shares, into the share market, which is, in our opinion, a kind of manipulation. But we also believe that it will not turn the trend around. In other words, it may have a temporary positive impact, but the underlying trend will reassert itself pretty soon. What is interesting is that this downward trend in the Chinese stock market has not been reflected in other stock markets. Even in Japan, the Nikkei index is going up, and certainly not in Europe or America. Obviously, a downward trend in the Chinese economy and stock market may have a negative impact on shares like Naspers and Prosus, which are heavily invested in Tencent, and that in turn has its business in China. But our view is that the Chinese economy will inevitably be dragged up with other economies as the US economy continues on its boom progress. All right, so much for America and China. Let us now turn our attention to what is happening in Europe. Ukraine, the war there now is 2 years old, and many say that it has reached some kind of stalemate. They say that there's been no significant progress made in 2023. But we disagree. We think that in 2023, certain important things happened. For example, Ukraine has taken control of the Black Sea, away from the Russian Black Sea fleet. They've done this using their ingenious sea drones and also long-range missiles given to them by countries like the UK. Using these munitions, they have forced Russia's Black Sea fleet to withdraw hundreds of kilometers away. And this has opened the way for commercial traffic to Odessa and other ports in Ukraine. Then secondly, the other thing that's happened is that Ukraine seems to have taken control of the skies, especially over Crimea. They downed a Russian A-50 command and control aircraft the other day. And they have been downing several Russian fighter planes as well in recent days. And helicopters, of course. The destruction of many aircraft has taken place on the ground in Crimea. And of course, control over the air opens the way for a landing on the Crimean Peninsula. In other words, instead of having to fight their way down from the top to Crimea, they can now just go through the sea and land troops on the Crimean Peninsula in order to establish a bridgehead there. Obviously, if they do something like that in the new year, in the spring, it will be very, very important. A landing in Crimea will be very difficult for Putin to counter. He will have to decide where he's going to find the troops to counter it. At the moment, he has 600,000 troops strung out along a 1,000-kilometer border. They are exhausted, demotivated, and poorly trained. Putin has been forced to place the Russian economy on a war footing, so that now about 40% of gross domestic product is just allocated to the production of military hardware. The country is producing or repairing about 100 tanks a month. It is also firing about 5 times as many shells as Ukraine is firing. But Ukraine's shells are far more accurately fired, so they have a greater impact. So far, Russia has lost at least 4,000 tanks, probably more. By contrast, Ukrainian troops are highly motivated, well-trained, and they are much more effective. They are also equipped with modern NATO weapons, which tend to be more accurate. A recent encounter between an American Bradley infantry fighting vehicle in Ukraine and a Russian T-90 tank demonstrates the difference in the motivation and training of the troops, as well as the quality of the equipment. A Bradley infantry vehicle is really meant to move troops around on the battlefield. It is not really meant to take on a main battle tank like a T-90. But in this particular case, the Bradley was so aggressive and so effective that it basically destroyed the Russian T-90 tank. And this demonstrates the difference between the two sides. To us, it seems that Putin is just hanging on in the hope that Trump will win the elections in November in America. He's hoping that the $61 billion aid package, which is currently bogged down in the US Senate and House, will be kept there and not allowed to pass by his Republican friends there. We believe that that package will pass, probably sooner rather than later, in some form. And of course, the European Union has just approved a 50 billion euro package of aid to Ukraine. So that will help to consolidate the position in Ukraine until the package in America comes through. This war, of course, has been far more protracted than anyone expected, us included. But we believe that it may well be resolved during 2024, during this year. Let's hope so. Okay, let's turn our attention to South Africa. Things are moving along here as well. In the political area, the DA now expects to get about 32% of the vote in the coming election. That is significant. That is much more than they got in the last election, that's for sure. And that, of course, is according to their polling. But their polling has been reasonably accurate and is pretty scientific from what we can see. It is just possible that their coalition with other smaller parties will give them enough of the vote to oust the ANC in the election. We note that Roger Jardine, who was previously the chairman of FNB, has offered to be the figurehead of the coalition, and he favours a laissez-faire type of government, which means that the private sector will do most of the work and the government will be reduced to a minimum. These are radical changes after 30 years of ANC mismanagement. From an investment perspective, change always brings uncertainty, and uncertainty is generally bad for equity shares. The ANC, of course, could be returned with a slim majority, or maybe just enough of the vote to make a coalition with one of the smaller parties that would enable them to control Parliament. But it looks fairly certain that the ANC is going to take a severe beating. And of course, they should be taking a severe beating. In our view, another 5 years of ANC control of this economy will be disastrous. The ANC has in the past used its parliamentary majority to force the NHI bill, the National Health Insurance Bill, through Parliament. They present it as an historic achievement. But the NHI is unaffordable, and the private sector has said that they will oppose the bill in the Constitutional Court if Ramaphosa signs it into law, and that means it will be tied up in the courts for years. Clearly, the passing of the NHI at this moment was an attempt by the ANC to win votes with some kind of a populist measure. And we can expect other things like this to happen before the election. Jacob Zuma's decision to back Umkhonto we Sizwe will certainly hurt the ANC. The ANC was always going to lose a big chunk of the Natal vote, but his defection makes that situation worse. The IFP, which is a member of the DA's coalition, will certainly benefit. The resignation of Mavuso Msimang from the ANC Veterans League, he was the deputy chairman there, comes at a critical time for the ANC. Msimang says the ANC's corruption is hurting the poorest people in South Africa. He describes it as a great shame for the organization, and he has been a member of the ANC for 60 years. The ANC has clearly deteriorated significantly over the last 30 years, in our view. Turning our attention to America and its impact on our political situation here, a letter from a bipartisan group of 200 members of the US Congress condemns South Africa's case against Israel for genocide. It seems that once again our government is endangering critical relationships with overseas trading partners. our position on this could have serious economic consequences. But in our view, Israel has clearly gone too far in Gaza. I don't think there's much doubt about that. America's continuing support is even damaging Biden's image in the US and may have an impact on his popularity at the November election. So let us hope sanity prevails and that war comes to a speedy end. Okay, as far as the economy in South Africa is concerned, GDP growth was expected to be about 0.3% in the third quarter, but came in at a minus 0.2%, and it's expected to be lower in the fourth quarter. And if it is also negative in the fourth quarter, that will obviously give us a technical recession, because 2 quarters of negative growth is a technical recession. The problems mainly come from logistics at Transnet and also at the Durban port. Load shedding, of course, continues to play a role, restricting productivity. Manufacturing is down 1.3%, mining is down 1.1%, and agriculture is up about 9.6%. The figures had a negative impact on the rand, not very strong negative impact, but a negative impact nonetheless. Fortunately, the rand has been sustained by the switch to risk-on sentiment overseas, following the S&P 500's fairly steep climb in recent days. Consumption, which is about 66% of gross domestic product, shrank by 0.3%. It's a sad reflection on the ANC's desperate mismanagement of the economy. The IMF revised its estimate for South Africa's gross domestic product growth in 2024 to just 1%. And they brought that down from 1.8%, which was their estimate in October last year. And it's interesting to note that sub-Saharan Africa is expected to achieve a growth of 4.3%, and the world average is expected to be 3.1%. So we're running well behind the African continent, and we're running well behind the rest of the world as well. The Monetary Policy Committee decided to leave rates unchanged for the 4th time at their most recent meeting. They want inflation to be anchored at the midpoint range around 4.5%. Core inflation is expected to be 4.6% in 2024, and the Monetary Policy Committee is estimating that the economy will grow by 1.2% in 2024. Of course, our interest rates are pegged to the American interest rates, so that we can keep our bonds and stocks attractive to overseas investors. Headline inflation in December was 5.1%, down from November's 5.5% and October's 5.9%, which indicates that inflation is trending downwards. The whole of 2023 saw average inflation at 6%. Bank of America predicts that interest rates will begin falling in South Africa from July 2024, and they predict 3 25 basis point cuts before the end of the year. The ABSA Purchasing Managers Index fell sharply in January to 43.6, down from 50.9 in December. Obviously, anything below 50 is contractionary. Anything above 50 is expansionary. Private credit extension rose by 4.9% in December, somewhat more than expectations of 4.1%. Household credit increased by the lowest amount in 2 years. Overdrafts were down 4.2%, but installment sales were up 7%. Retail sales in South Africa fell 0.9% in November from the previous year. And this follows October sales, which were down 2.3% on 2023. Clearly, Black Friday was not so good this year. Disposable income available to households has been falling for 9 months. This is mostly the result of much higher interest rates. Mining production was up 6.8% in November, following October's increase of 3.6%. Platinum group metals output was up 15.2%, coal was up 10.6%, and iron was up 20%. Gold and manganese were down. Mining sales are dependent on Chinese demand, and Chinese demand, as we have indicated, is in some trouble at the moment. The Bank Serve Economic Transactions Index shows that transactions increased by 1.9% in December, probably due mainly to lower fuel prices. Motor vehicle sales were 3.8% lower in January 2024 than they were in January 2023. And that comes after a 9.8% slump in December. And it's the 6th month in a row now that vehicle sales have been falling. Consumer confidence fell to -17 in the last quarter of 2023, which is about the worst level in 20 years. On the positive side, the construction industry seems to be doing pretty well. The Afrimat Construction Index showed a rebound in the third quarter to a 7-year high. The sector created 145,000 new jobs and consumed about 10% more materials. They, of course, have not been much impacted by the problems at Transnet and the harbours. All right, let's turn our attention briefly to Eskom. The Integrated Resource Plan, which has just been produced in January 2024, has been described by experts as an admission of failure by the government in its efforts to eliminate load shedding. It replaces the IRP from 2019, and it apparently lacks detail and fails to provide solutions to the major problems. The ANC's inability to solve the power crisis in 16 years is going to cost them dearly in the coming elections. Notably, Eskom's energy availability factor fell further in 2023 to 51% on average for the year, down from 2022's 54%. Electricity production in November 2023 was 3.3% lower than a year ago. There were 630 hours of load shedding compared to 263 hours of load shedding. So that was in the 630 hours of load shedding was in November compared to 263 in October last year. Eskom sales of electricity are down 6% in the 6 months to September 2023. And it's interesting to note that the municipalities owe Eskom 70 billion rand as at the 30th of September last year, and its debt rose to 443 billion. When the ANC took over in 1994, they were handed a functioning electricity system. It was one of the cheapest and most reliable power utilities in the world. Its inexorable demise is a damning indictment on the ruling party. The Reserve Bank says load shedding could cut as much as 2% of GDP growth in 2023. Deloitte, the firm of auditors, estimates that the 14 years that we've had load shedding in this country have cost the country about 3 trillion rand. We can only imagine what the effect of that has been. If you add 3 trillion rand back onto the South African GDP, it would have a major impact on this economy. Fortunately, the private sector has stepped into the gap that Eskom has left, and power from solar panels has doubled to 4.8 gigabytes in a single year. So the year to the 31st of August 2023, we saw solar panel power double in this country. NERSA this year has approved 900 megawatts in 98 new projects in just the last 3 months. Transnet, of course, has been big in the news since we spoke last. It's the next state-owned enterprise to require substantial bailout. Their current debt is 130 billion, and it will need about 50 billion over the next 2 years in order to just stay afloat. The debt comes from corruption, incompetence, and mismanagement. Transnet, like Eskom, is also too big to fail, and so the Treasury will have to step in, and that puts them in a very tough position considering their goals of consolidating our debt in this country. Transnet is battling because it can't get spares for its engines from the Chinese supplier. Also, there are huge losses from theft and vandalism. Overall, it made a loss of 1.6 billion rand in the 6 months to 30th September 2023, and it's now asked the government for 47 billion rand to stay afloat. In 2023, it delivered 48 million tons of coal to Richards Bay. It is contracted to deliver about 60 million tons, and it has in the past delivered more than 70 million. The Richards Bay coal terminal is operating at about 50% of its capacity. This forces mining companies to deliver ore by road, and of course that is about 4 times more expensive than rail, and that's forcing some mining companies to retrench and cut back. Transnet has had about 4,600 kilometers of copper cable stolen in the 3 years to October 2023, and about 3,600 kilometers of its tracks have fallen into disuse as a result. The rolling stock position is so bad that private enterprise has stepped in to buy parts for the 200 locomotives that are sitting idle at the moment. The CEO, the Chief Executive Officer, and the Chief Financial Officer of Transnet have recently resigned. The new CEO is a lady called Michelle Phillips, and she seems to be doing a good job. So let us hope that there is some kind of a recovery in that state-owned enterprise. Okay, a few general points coming out of my reading over the last 2 months. The COP28, the climate conference, it was held in Dubai last year. They came to the conclusion that the world is at or close to at least 5 major tipping points on climate change. The world is at 1.2 degrees Celsius above pre-industrial levels, and that is still below the 1.5 degree limit that was set back in 2015. But renewables have been insufficient, and the effect of greenhouse gases has been worse than expected. The ice sheets in Greenland and Antarctica are melting faster than predicted, mainly because of warmer sea temperatures, which now are irreversible. So there's no business as usual way forward here. The experts are telling us that we now need to make some radical changes. For example, they say emissions must fall by 43% in the next 6 years before 2030. We simply do not believe that that is going to happen. OPEC, for example, is predicting that oil consumption will increase from 102 million barrels per day, which is where it is now, to 111.6 million barrels by the year 2045. So they obviously are not seeing any reduction in emissions. And of course, you need, as a private investor, you need to think about how climate change is going to impact on the shares that you hold or that you are considering buying. It's going to become a major factor in investment pretty soon, in our opinion. Okay, let's look at AGOA, the African Growth and Administration Act. This act is an American act, and it's designed to stimulate growth on the African continent. And Fitch, the ratings agency, says that South Africa's membership of AGOA will not only be renewed, but it will be renewed on better terms, because South Africa is the largest exporter from Africa to the United States, and the US is South Africa's is the second largest exporter to South Africa after China. Our membership expires on September 2025. About 9% of our exports go to America, and only 20% of those benefit from AGOA. So AGOA affects about 2% of our national exports, our annual exports, and the total of that's worth about 3 billion rand. Fitch says we've got about a 65% chance of having better terms when the new AGOA is approved. And a major factor there was when we did not allow Putin to come to the BRICS conference here in South Africa in person. That's seen as a positive factor. Okay, another interesting point under general is that the government now owes about 11 billion rand to suppliers at more than 30 days. They're supposed to pay, anyone who supplies the government is supposed to be paid within 30 days from invoice. But there are now 117,000 invoices which are older than 30 days in the government. This puts hundreds of small and medium-sized businesses at risk. Some have already gone into liquidation because of it. And the situation is 12% worse than it was a year ago. Only about 37.5% of national departments comply with the 30-day rule. The Gauteng Department of Health is one of the worst. It accounts for 38.8% of the outstanding invoices in Gauteng alone. So that's something to think about. The rand is in a long-term weakening trend. Let's just take a look at that on the charts here. Okay, I think you can get the general drift. You can see this long-term weakening trend here on the screen, where the rand is making higher lows and higher highs. So the trend is generally in this direction. It's going from the bottom left-hand corner of your screen to the top right-hand corner. That shows that the rand is getting weaker and weaker against the US dollar. It's now being impacted, of course, by the uncertainty over the coming election, as well as the ongoing load shedding and the problems at Transnet. But Bank of America is predicting that the rand will strengthen this year. They say that the rand will reach 17 rand 30 to the US dollar by year end. This is based on the fact that rates will begin to fall in the second half of the year. We agree that the rand could improve, but mainly because of the shift towards risk on, which is coming in overseas investors. As the S&P 500 continues to strengthen, international investment sentiment is improving, and some of that spills over into emerging market currencies like the rand. And we certainly see the rand as being relatively oversold at the moment. But the long-term trend remains one of further weakness, and you have to take that into account. Okay, let's look at some companies now. With the bull trend now back in full swing on American markets and other markets, most quality shares are rising. The JSE overall index has been trying to follow Wall Street up, and we believe that sooner or later it will post a new record high. And we, of course, have covered some of those shares that are benefiting there. The two that we've done recently in articles are CA Sales and Foresight. They're in our current recent articles. But the following shares are also worthy of your consideration. First one I want to look at here is AVI, Anglo-Val Industries. This is an icon in South Africa. Take the volume off here. Maybe put a bit more data on here. You can see that it's made a bottom down here in May, June of 2023, and it's been rising since then. This is an extremely well-known manufacturer in South Africa of food, clothing, and cosmetics. It's got some key brands like I&J, Fish, Five Roses Tea, Salty Cracks, Frisco, Provita, and Yardley. So they have some very important South African brands. And it's an investment in South Africa. If you buy these shares, you are buying South Africa. And particularly, you are buying the level of consumer spending. In our view, the share has peaked quite a while back. It peaked in February of 2018, in fact. So let's just put a bit more data on the screen. You can see there's the peak, and then it began a long-term downward trend. But if you put a trend line on here, a long-term downward trend line, connect these two tops here with this one up here and that one, you'll see that we had an upside break over here. So we advise you to do that, and the break came on the 9th of November at a price of 74.18. It's now moved up to about 86 Rand, even a bit higher, which is a gain of about 16% over 2 months. In a recent trading statement for the 6 months to to the 31st of December, the company expects to produce headline earnings per share which are 16% to 18% higher than they were before. So this is a share which we think, a blue chip share, which we think is recovering. The next share I want to look at is Mixtel. Mixtel, of course, is one of two vehicle tracking companies on the JSE. The other one, of course, is Karoo. It's an international service company with high and rising annual annuity income. So the beautiful thing about this company is it gets most of its income in the form of debit orders. It has very, very low working capital. So it's got almost no stock and no debtors. It's a service company, but it's got a strong annuity income, which means that basically before it opens its doors at the beginning of the month, it's already made a profit. In the 3 months to the 31st of December, it added 52,400 new subscribers to take its total number of subscribers to 1,142,000. Revenue was up 6%, and its earnings before interest, taxation, depreciation, and amortization, its EBITDA, was up 24%. And as I said, it has almost no working capital, which makes it a very low-risk investment. We added it to the winning shares list, as you can see over here, where this little red arrow is here. It was then 590 cents, 595. It's since moved up to about 710 cents, now 740 make that, which is a gain of over 20% in about 5 weeks. Okay, so the next share I want to look at is Harmony. This is a marginal gold mine, quite a different kettle of fish. Its cost of extraction is relatively close to the gold price, so that tends to make it quite volatile. Its cost of extraction at the moment, its most recent update, was between 820,000 and 835,000 rands per kilogram. Okay, the current price of gold is about 943,000 rands per kilogram. So that gives it a margin of about 108,000 rand per kilogram of gold that it produces. A drop in the gold price can wipe out that profit very quickly, and a rise in the gold price could double it. So that makes the share price relatively volatile, and obviously very much leveraged to the current gold price in dollars and in rands. Right now, however, it's in an upward trend, which you can see on the screen here. Very strong upward trend, and we added it to the winning shares list a while back in November. Let's see here, on the 16th of November, 14, 15, 16. So on this day here where I'm pointing, and it's since then it's moved up quite strongly. We added it about 99 rand and 20 cents, or 9920 cents per share. It's moved up to about 121 rand a share. So it's a gain of about 22% in 10 weeks. And we believe it might go further if the gold price continues to improve or the rand starts to weaken. Either of those things could be very positive for it. Okay, Bell. Bell is a manufacturer and distributor of heavy earth-moving equipment. It sells its products mainly to the construction industry, also to agriculture and waste management. This company was not much affected by COVID, and also has not been affected by obviously what's happening at Transnet or load shedding. Those things don't seem to impact it much. It was added to the winning shares list on the 27th of October, so that would be about here. The price on that day was 18.75, as you can see from the chart. It's now moved up to, where is it now? It's at 23 rand 14 a share, so that's a gain of about 24.5% in 3 months, just over 3 months. And it was initially in a very strong upward trend, but it's been moving sideways for a while. We think the upward trend will continue, so we believe that this share is potentially a good one. Another one to look at is Calgro. Calgro M3 is a property developer. This This share has been doing well. It basically makes its money by building and selling residential properties on a margin of about 22%. It has a small interest in memorial parks, burial parks. In its results for the 6 months to the 31st of August, the company handed over 949 units, which they sold, and it has about 2,118 properties which are currently under construction. In that 6-month period, its revenue was up 13.5%, and headline earnings per share was up 38.4%. Obviously, this company is very profitable and has a good, strong cash flow. It's also been buying its own shares back. It bought 22.6 million shares back for an average price of 263 cents. And when you consider that the current price is 497 cents, that has been very good for the shareholders who remained in the company. And of course, you mustn't also forget that this company has a net asset value of 961 cents, which is predominantly in property. So in our view, it's something of a bargain. We added it to the winning shares list a while back in August last year at 356 cents, and so far it's up about 40% in 5.5 months since we added it. Okay, folks, that's about all we have today for you. I hope that you found something of interest and of use in this presentation. And don't forget to go and look at the notes, which will be on the website this evening at 6 o'clock. Also, if you want to follow me on Twitter, go down to the bottom of this message in the details underneath here. You can find a link to my Twitter feed. Otherwise, thank you very much for listening to me, and I'll talk to you again on the first Wednesday in March. Thank you.